Every day, the world moves on as it always has. Cities wake up, work begins, and life feels familiar. But beneath that sense of normality, something is shifting. The climate is changing, and the systems we rely on, energy, food, water, cities, finance, are under pressure in ways we're only beginning to understand. These changes don't live in reports or projections, they are already shaping people, livelihoods, and communities. We created the Climate Leadership Podcast so these challenges don't remain abstract or distant, but are explored through the people working inside these systems, making real decisions with real consequences, often without clear answers. This is not a space for fear, blame, or perfection. It's a space for honest conversations about what leadership looks like in a changing world. If you're listening, you're already part of that leadership. Let's begin the conversation.
Welcome to another episode of the Climate Leadership Podcast, where we go beyond ambition and frameworks to explore how climate and sustainability decisions are actually made inside institutions. Today's conversation is about defensibility. ESG and climate risk are now embedded in investment language, but when portfolios are large, governance is complex, and fiduciary duty is real, the question shifts from whether to integrate ESG to how to do it in a way that stands up to scrutiny from boards, regulators, and markets. To explore this, I'm joined by Mr. Hugo Jair Sánchez, an investment and risk management professional with over a decade of experience across asset allocation and portfolio risk. Most recently, Hugo served as Chief Risk Officer of Mexico's Public Pension Fund Administrator, overseeing a USD 28 billion in assets across public and private markets. He has led the integration of ESG and climate risk across large portfolios and worked directly with regulators, boards, and investment committees. Today, we'll discuss what it really takes to make ESG and climate risk decision useful, not just reportable. Thank you, Hugo, for joining us today. And as we start, can you please introduce yourself for our audience?
Thank you so much. Thanks so much, Amber, for giving me this invite. It's a pleasure for me to be here with you. And as I told you, this is my first time on a podcast, so thank you so much for this experience. And well, as you said, my last role, I work as Chief Risk Officer in Mexico, in a big pension fund administrator. It is the only one that is completely public. There are 10 big pension funds in Mexico. One is like the public one. So there I was in charge of managing all the risk, including market risk, credit risk, liquidity risk, also all the operational risk side, business continuity. And there I was in charge of implementing all the ESG criteria, sustainability strategy for the pension fund. And I end up also implementing the first methodologies to assess climate risk for the portfolio. So now I'm studying here at Imperial College London, Master's in Climate Change Finance. So I'm quite keen on keep working on the financial sector and improving all related to climate finance.
Sure. So let's get started. When you hear the phrase defensible ESG and climate risk, what does that actually mean in large portfolio context?
Okay, when I think about defensible ESG and climate risk in this large portfolio context, the first thing that comes to my mind is institutional embedding. So defensible means that ESG and climate risk management are not superficial or symbolic. They need to be truly embedded within the institution. Mm-hmm. So that begins with governance. There must be clear accountability from the board, the investment committee, the risk committee, mm-hmm. and senior management. So that includes CEO, the chief investment officer, the chief risk officer. Mm-hmm. And also policies need to be defined responsibilities explicitly And those responsibilities must cascade through investment, risk, and operational teams. So that's something that is quite important, because without a robust governance, ESG integration remains more like aspirational rather than structural. The second thing that I would say is that defensibility requires defined processes and transparent methodologies. Institutions must demonstrate how ESG and climate risk are identified, assessed, monitored, communicated, and incorporated into portfolio management. So, and also your policies and methodologies must comply with regulation. So that is essential, of course, but regulation is still evolving in many jurisdictions. So remaining aligned with emerging standards and best practices is critical to demonstrate professionalism and also robustness to boards, regulators, and also the markets. For example, relying solely on qualitative climate assessments is no longer sufficient, because today institutions are increasingly expected to move towards quantitative risk measurement. So you need, of course, to implement scenario analysis, stress testing, also the integration of those elements into financial metrics. So that's also what defensible means. And the third element I would say is that ESG and climate risk management must inform decision making. It must be capable of being, explained in terms of risk adjusted return, and also linked to fiduciary duty, because ultimately it's not about proving that ESG is morally desirable, which it can be, but the actual value of ESG and climate risk management comes when you can demonstrate that climate and sustainability risks are financially relevant, and therefore they must be integrated in the portfolio and the processes of the institution. And just like the market risk, credit risk, or liquidity risk are like normal into these types of institutions. And when governance is clear, methodologies are rigorous, and decisions are, financially grounded, I would say that then is when ESG and climate change integration become actually defensible.
Okay. So, Hugo, I mean, I'm not coming from a finance industry, so I was just thinking that when you decide on the portfolio level, right? So are you considering the climate risk at present?
Yeah, I mean, like, would you, when you are like in these type of institutions, commonly, probably, I think that can happen is that they end up like turning ESG into a boxing picking exercise,
Okay.
So ESG become that like a box picking exercise when it is disconnected from governance and day-to-day investment operations. So it happens when institutions treat ESG primarily as a reporting requirement or a compliance exercise rather than a risk and capital allocation discipline. So in those cases, ESG may appear in sustainability reports, dashboards, or scoreboards, but it's not truly embedded in the investment processes. Okay. So the real test is whether ESG and climate analysis influence positioning, sizing, cost of capital assumption also. They must end up being related to risk limits and exposure decisions across sectors, geographies, and asset classes. Because if you can translate that, then it's like the objective of actually managing the climate risk within the institutional investor side and the portfolios, it doesn't make really sense.
Okay.
So the real test is whether ESG and climate analysis influence position sizing, costs, as I said, capital assumptions, risk limits. And also, if those metrics do not affect how capital is allocated, then ESG remains, I would say, more cosmetic. So I would say that a common failure or the most common failure I have observed is measuring everything, or these institutions that tries to measure everything and reporting extensively, but in the end, ESG and climate doesn't translate in decisions. So I believe that's like a thing that should be avoided at all costs.
Okay.
So these types of institutions have like no adjustments to strategy. They don't change, or there are no changes in the portfolio constructions, or no recalibration of the risk appetite. So I would stress that the issue is not lack of good intentions, I mean, in these institutions, but because most institutions genuinely, I believe, want to do the right thing. So that's something positive. But the problem comes and arises when ESG and climate insights are not actually translated into decision variables. So variables that, I mean, influence expected returns, volatility, also downside risk and opportunity identification, because we related a lot, and it's more related climate risk with the downside problems and risks. But at the same time, for some business sector, climate risk is also, or brings opportunities. So also looking at how a sector could change and deliver more value, become more, resilient against climate change is also an opportunity. So these types of elements should not be just like focused on reporting and doing nothing. They must become like a valuable source for the institution.
Okay.
So I would say that, sorry.
Yeah, so at what point does ESG or climate analysis genuinely influence asset allocation decisions?
When? I would say that, and based on my experience, ESG and climate analysis genuinely influence asset allocation when two conditions are met. First, when governance and culture begin to actually internalize these issues, like, because as I said, like everything starts with governance. So integration does not happen immediately. It begins when investment teams, risk teams, committee members, and ultimately the board understand that climate and ESG factors are financially material, not simply regulatory or reputational considerations. So when decision makers recognize that these risks affect the long-term portfolio resilience and the results and returns, then the conversation shifts from compliance to capital allocation. So that's the first element, I would say. And the second is that influence becomes real when the analysis is robust enough to affect the financial variables. So for putting that in context, when ESG and climate assessments must be capable of changing expected returns, assumptions, also expected volatility, the downside risk, or long-term, growth projections. So for example, if exposure to transition risk or physical climate risk leads you to adjust sector allocations, reassess also stranded assets exposure, or revise the long-term earnings assumptions, that's when things come like or become a real influence, you know? So I would say it also becomes particularly material when climate scenario analysis informs strategic asset allocation decisions. So especially in long duration portfolios, such as the pension funds. So when that happens is when I would say that it becomes like a thing. At that stage, you move from beyond relying on external ESG scores and begin actually asking deeper questions, like, is the company conducting robust climate risk analysis in which I'm gonna invest, or I already maybe have like some position in this company. So the actual questions become not just like to focus if this company have a good ESG score or not. It's more like, okay, is this company exposed to these climate risks, to some climate risks?
Right.
And if they are, so is the company conducting a robust climate risk analysis? Is it managing those risks effectively? Are they mitigating, or they have mitigation strategies that are credible? Because if not, like, in other words, you assess whether, you know, portfolio value is truly being protected and managed. So if climate analysis only lives in sustainability reports, I would say that it is more symbolic. But if it shifts capital allocation and the strategy, then I would say that that's when it becomes real.
Okay, I understand. So if a company is genuinely using or taking in his strategy, in company strategy, ESG as a major factor, then you think that it's really putting in capital and working on it, right?
Yeah. It's when things becomes real. Is not like, you know, cosmetic. It's like they are using, and like from the company side is that they are actually doing something, and from the investment side, as you as like a pension fund, you're actually taking into account the real actions that company are taking place or doing, and that leads you or let you know if the risk exposures that you have like are actually being managed or not.
Right.
Yeah.
Okay, sure. So how do you decide which ESG and climate risk, are material enough to act on rather than just disclose?
Well, I would say that materiality must be assessed through financial, you know, transmission channels, and those channels vary depending on the asset class, the underlying asset, and the way in which value and cash flows are generated. So the starting point is always a financial question, like, does this ESG or climate factor actually affect expected cash flows? Does it affect cost of capital? And does it introduce regulatory risk, litigation risk, or potential asset impairment, for example? So when you start like doing those questions, and if the answer is yes, particularly if the impact could have could be asymmetric, you know, systemic or long-term for your portfolio, then and if it can materially influence the asset valuation, then it moves from disclosure into active risk management. So I would say not every ESG issue is financially material for every portfolio. You as an investor, probably for the company it might be, but in which you held investment. But for you as the investor, not every ESG issue is a problem. So for example, for a financial institution as a pension fund, the discipline lies in distinguishing between what is actually relevant for reporting and what is relevant for valuation and capital allocation. So that distinction is essential if ESG integration is to remain credible and defensible for like an investment institution.
Okay. So moving forward, what are the practical challenges of integrating frameworks like ISSB, IFRS S1 and S2, TCFD and SASB into day-to-day investment processes?
Yeah, I believe this is one of the main challenges, right? That now institutions are experiencing. I would say that one of the first challenges is navigating what many call this alphabet soup, like many names with different alphabets, trying to say something about like frameworks. But the first challenge is understanding how they relate to one another and how they are evolving also, because we have seen, and I believe that's not like an advance for the financial sector. We have seen consolidation, particularly with ISSB now using IFRS S1 and S2. Building on TCFD, and I believe TNFD is coming also to become part of. So that convergence is positive. So the challenge today is not like conceptual alignment. So it's more like, but how do you become like, how do you actually translate this alphabet soup and all the principles and methodologies that they try to how they, in the end, they try to show how to navigate to financial institutions and to companies or businesses. But in the end, they are just like brought to play those principles into real action. I believe is the challenge. Right. Because these frameworks define what should be disclosed, but they do not prescribe exactly how to embed those principles into governance, for example, into risk systems, and into the investment processes. So making that possible in an efficient and valuable way is the key, I might say. And a second major challenge is data. Availability, the quality, and comparability is key, because without reliable and consistent corporate reporting, it is very difficult to translate disclosure standards into portfolio level risk metrics. So when you are like in the risk management side, you need to to manage or to assess the risk. But if the companies do not disclose accordingly to the standards, of many times they do a big effort, but in the end they are not sharing the important pieces of data that you need for assessing how they are exposed to, for example, climate risks. So that's when it becomes challenging. And with this mix of alphabet soup, many companies or businesses have taken or signed some principles, others have signed other frameworks, but in the end, what happens is that they end up just reporting important data, but not enough, and is not comparable in many times. So that's a big challenge for the financial institutions, I might say. And finally, I would say that proportionality also matters, because larger institutions can absorb complexity more easily, but the smaller teams may struggle. So the key, in my view, I would say, is to integrate these frameworks into existing risk management structures is the main thing. not just to build parallel sustainability systems to operate separately from mainstream investment decisions, because many times that happens also from the investment side, Financial institutions bring and build up like sustainability teams that becomes a silo, and they are a silo, and the risk management area and the investment area or the team are not well integrated. So I believe that's a challenge if you want to bring ESG and climate risk management into the main decisions.
Okay. So moving forward, in your experience, where do boards and investment committees tend to push back most on ESG and climate risk integration?
I would say that boards typically push back on 3 areas, I might say. First, evidence, like they want to understand the financial basis of the analysis. So what is the impact on valuation? What is the transmission mechanism? How robust is the modeling? Because in the end, like boards and committees are there, and their responsibility is to have this or seek for the fiduciary duty of the investment or the portfolio. So they need to have like the financial basis. So you need to come, and if you cannot like translate how climate things or environmental things can actually affect the financials from the investment positions, that's when like things start like not working in the sense that, and as the principles ask for the financial institutions to run. Second, I would say that time horizon is very important, because especially when climate risk extend beyond the traditional investment cycles, even in long-term institutions such as pension funds, there can be tensions between short-term performance pressure and long-term climate exposure. So that's also something that is quite important, because in the end, the board seeks for results, right? And results comes with having like a high enough, earnings and hitting a good return and risk, a mix. So many of these climate risk comes with long-term like impacts. So that's something that is also an area or a source of, like tension between them.
Right.
And the third, I would say that is the perceived trade-offs with return. As I said, like investment committees remain responsible for delivering competitive risk-adjusted returns. So they must consider market conditions, liquidity, market depth, all strengths. For example, in some jurisdictions, and I could say that happened in Mexico, particularly for pension funds, like regulation limit exposure to certain asset classes or regions. So that means that even if an institution recognizes transition risk in a given sector, it may not be immediately feasible to divest or substitute those exposures without affecting return diversification or regulatory compliance. So the pushback is not necessarily ideological. It is often structural and fiduciary. So I would say that is like a thing. And so the role of ESG and climate integration, therefore, is not to override investment discipline, but to enhance it with better long-term risk awareness, I might say.
Okay. So what signals tell you that an ESG or climate framework is actually working, not just looking good on paper?
I would say that 3 signals tell me ESG integration is real. One is that investment memos explicitly reference climate risk scenarios. So, you're not just like putting scores or relying on external ESG scores, because many investment teams might do that. Like they just like get the score that they get from one source, or probably it came from Moody's, S&P, Bloomberg, whatever. But they actually don't like understand what that means, and what is like what is like backing up that ESG score. So and you can see that or understand that some institution is not understanding climate risk. For example, if you would like to know if they are doing something related to climate risk, is that they report ESG scores and they mix up the ESG score with climate risk, because it's related, but it's not the same. So when you can like see that there's like a lack of understanding when they mix up those like ideas. I would say the second signal that I would look for is if its capital is reallocated based on ESG climate risk adjusted assessments. So when you can see or identify that, at least when they are identifying and measuring some exposures, for example, for climate physical risk or for transition risks, if they already identify that and identify that big exposure, because like not all risk needs to be like avoided. Some you can like maintain some investments also, because you know that even if there are risks, they are not like going beyond your limits. But if they already know that some risk could like cross that threshold, then you need to show that at least you have a plan or you are doing something to reallocate and readjust the portfolio in some way, so it could become more robust against those risks. And three, I would say that risk dashboards influence limits and hedging strategies. So when ESG affects position sizing, underwriting standards, or cost of capital, I would say that is when you can like actually identify that it is working. And if it only affects, branding or reporting, then you could say that it isn't.
Okay.
Yeah.
So finally, looking ahead into the future, what will make ESG and climate risk truly non-negotiable in investment decision making?
Oh, that's hard, but I would say that two forces will make ESG and climate risk non-negotiable. First, regulatory standardization. When frameworks like ISSB are reducing ambiguity, then that will help, because the business side and the business sector and the financial sector will end up like speaking the same language, and that's when like many things, because like I believe both sectors are trying to advance on climate and in environmental management also, and become like more sustainable. I believe both sectors are working on that, but many things becomes like not doable enough because of coordination, because both sectors probably are using different languages, different frameworks. So I believe that when all of us start doing or using the same taxonomy, sustainable taxonomies, the same frameworks for reporting, understanding and reporting, and like the same values for the climate risks, climate change risk and stuff, that's when That's when regulation gets to standardization. I believe that's when, in one part, climate risk will truly be non-negotiable in the investment decisions. And second, I would say when physical and transition impacts becoming financially undeniable. And that's a hard truth. We're studying this, but when people start not guessing if it could be or not could be material, when the value of assets start to actually have some or experience some downside because of the impacts of climate change, then it's like, as climate volatility increases and capital repricing accelerates, then ESG will stop being more optional, not because of ideology, but because it is and will be a risk reality. So financial materiality, I would say, is the one when it's like that is the thing that will drive the future for climate and finance, climate management, and also sustainability finance. Ultimately, fiduciary duty will demand it, because if climate risk and ESG, elements are actually impacting in the value of your assets, then the board, the committees, and everyone will demand a good management for these topics, as they do now normally for market risk or credit risk or operational risk, tech risk.
Right. Perfect. So I think still some years to go when this kicks in and ESG becomes a non-negotiable risk for investment decisions. Right?
Yeah.
Okay, perfect. So thank you, Hugo, for such thoughtful and grounded conversation. This discussion is a reminder that ESG and climate risk integration is not about adding more frameworks or more disclosure, but about ensuring that sustainability analysis is rigorous enough to influence real decisions. Building defensible systems require clarity on materiality, strong governance, and the confidence to let climate insights shape capital allocation when it truly matters. For our listeners, ESG and climate risk do not operate in isolation. They sit within the fiduciary duty, regulatory expectations, investment performance, and institution culture. Understanding how these elements interact is essential if sustainability is to move beyond reporting and become embedded in portfolio strategy. Thank you for joining us on the Climate Leadership Podcast. We will be back soon with more conversation exploring leadership, decision-making, and climate action in practice. Until then, take care and have a nice day. Bye-bye.
Thank you so much. Bye-bye.